This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set for a rough start to the week after strong US jobs data leads traders and economists to scale back views on the Fed rate cuts. Regional bond yields already climbing in early trade. Little sign of relief for exhausted California firefighters, with hot, dry winds to fan the flames this week, leaving millions of residents in peril. And we'll be live in Shanghai for our exclusive coverage of the UBS Greater China Conference. We'll be getting the outlook for the world's second biggest economy from the bank's APAC president as Beijing stimulus struggles to take hold and stocks post their worst start to a year since 2016.
Yeah, the stock market rally really being threatened right now globally with the bond tantrum that we're seeing all over the world. Heidi, of course, we had the very strong jobs numbers out on Friday from the U.S. and that leading to that global bond rout. And could that derail the best two-year rally that we've seen across the world when it comes to stock markets since the dot-com era? This, of course, as we continue to watch broader market implications about the U.S. inflation numbers that we're going to get this week, not to mention, of course, that we are going to start the earnings season as well.
Yeah, I would say welcome back, Shery, but honestly, I don't think you've missed very much when it comes to sort of positive catalysts for these markets, right? Certainly, the story hasn't changed very much for the better when it comes to China since when we chatted last. The economic malaise, the sort of further risk of spiraling deeper into deflation, all of this is still gripping investors looking at China. And in fact, I mentioned the gloomiest start to the year for Chinese equities since 2016. The CSI 300 losing over 5% in just the first 7 trading days, or sessions, I should say, of 2025. So we're seeing this be compounded, of course, as we get closer to the incoming Trump administration, these rising geopolitical risks and tension fears over tariffs, as well as broader sort of macro pessimism in China as well. So we continue to kind of watch to see if many state funds will kind of be the main source of cash going into the onshore market this year, Shery.
Yeah, I don't know, Heidi. It's really interesting because all of the elements that you're talking about and the story seemed the same, but it was really surprising coming back from holidays, as you said, that the market reaction has been so big, right? I mean, take a look at how we're setting up for the Asian session. We do have Japan on holidays today, so that perhaps will mute a little bit of the reaction that we might see, especially with the global repercussions from that global bond yield rally that we've seen overseas, right? But Japan closed. The yen actually strengthened last week. It was interesting because Bloomberg had this report that BOJ officials could be discussing raising their inflation outlook. We're still talking, though, about a weakening Japanese yen. Take a look at that, very close to that 158 level against the U.S. dollar. So that really hasn't changed since I went away on holidays. But what we're watching right now is for more data. And data, I think, has been what's been really interesting and what's really sent those changes in perception of where investors go from here. We do get export numbers out of China. We get the GDP numbers. Take a look at how we're setting up with U.S. futures as well, because, as I said, it was really that Friday strong labor report that really changed the narrative even more, with markets pricing back, dialing back those expectations of more Fed rate cuts. We do have inflation numbers out this week as well that we'll be watching, but the S&P 500 posted the worst day since mid-December on the Friday session and actually turned negative for 2025. NASDAQ futures also pointing to the downside, Heidi.
Yeah, in a lot of ways, nothing's changed. In a lot of ways, certainly the market, perspective has changed, right, since you've been away. Let's bring in our Bloomberg executive editor for Asian markets, Paul Dobson, with a preview of today's market action. And it felt like those blowout jobs numbers was kind of, the final straw that broke this market's back, right? Do we expect this malaise to really continue? Is this the reality check? Because we're now seeing the expectations of the Fed to just only one easing move this year, and that's been pushed back potentially into the fourth quarter.
That's right. Good morning, Heidi. Yes, I think you can look at this on a short-term and a longer-term horizon as well. The short-term impact is quite clear, much higher yields, but also the pace of that increase, the pace of the adjustment that we've seen really shifting from close to 4% not too long ago, 4 months ago, or thereabouts, to close to 5% now, and still rising. That's what's really catching people a little bit by surprise here and weighing on other markets. That's what the stock market doesn't like. It's not so much the elevated yield levels. It can get used to that in time, but what it doesn't like is that sharp adjustment. And so that's why we're seeing a setback now for US equities, for example, and then the more immediate impact of a stronger dollar and weaker currencies around the rest of the world. But I think there's also this mindset right now that people are talking about. Is this the new normal, 5%? Are we going to be here for longer? Maybe the aberration was the period that we saw in much of the 2010 to 2020 period where interest rates were exceptionally low. Now we have the Fed policymakers talking about the idea that actually, even at these levels, policy isn't that restrictive. They're backing away from cutting further, as you were saying, and maybe in the second half of the year, depending on how inflationary those Donald Trump policies are going to be, we get back to the idea that they might have to raise interest rates further.
Yeah, is that the game changer right now, the fact that we're headed towards another Trump presidency? Because when we're talking about bond tantrums, Paul, I mean, we have seen that yield spikes can be very fleeting, like we saw back in 2013, back in 2023 as well.
Yeah, so the last time that we got to 5% on the 10-year, we didn't stay there for very long, of course, but that took some changes. It took the Fed shifting, and it also took the US adjusting the auction sizes and the sort of distribution of those sales as well in order to bring the market back down from those levels. This time, a second test of that level maybe will be more enduring. I think Trump isn't the only game changer. We've already got a strong US economy, exactly as that data showed, exactly as the inflation numbers are showing as well. And that's why the Fed is concerned about the market or the economy potentially overheating, even before you have a policy coming in that is also going to be most likely stimulative, therefore inflationary. And with this added risk that we don't really know at the moment about what tariffs could look like and how much more that might add on to the inflation picture as well.
China's interesting too, right? Because obviously last year we had an initial wave of enthusiasm after these stimulus expectations. Things have just deteriorated since then. Do you think what we saw from the government last week, the PBOC suspending government bond buying, the support for the yuan, is that helping or hindering investor confidence?
It's a good question. I feel like even without the PBOC buying, the bond market is in rude health in China. People are buying into it, and they're buying into it not because they like them, but because they're scared to put their money anywhere else, right? They're looking for some store of value when property looks risky, stocks look risky, deposit rates at banks are not very high either, and the inflation outlook and the monetary policy outlook is also gloomy. So it's been that haven play. What we did see last week was a bit of a backup in short-term interest rates, but that's more people giving up on the idea that the PBOC is going to be cutting its policy rates or the RRR anytime particularly soon, rather than anything to do with a changing outlook on the economy. So what the bond market is saying to the rest of the world and to China's economy and to the PBOC itself is, we do not think that the economy is looking very good at the moment, and we need more stimulus in order to reverse that. So that's the signal from the bond market.
Bloomberg executive editor for Asian markets, Paul Dobson, there with his views on the markets and, of course, a very busy week ahead. Subscribers can read today's big take on the terminal or by heading over to Bloomberg.com as well. Haidi.
Yeah, take a look, Shery, at some of the other stories that we're following. And the incoming US Vice President, J.D. Vance, says a deal to release hostages held by Hamas could still be struck before Donald Trump returns to the White House. Vance told Fox News it could happen in the last day or two of the Biden administration. White House security advisor Jake Sullivan also told CNN that a deal is close, but warned it could still fail. Israel said on the weekend that it was sending negotiators to Qatar for fresh talks. Korea's transport ministry says the black boxes pulled from a Jeju air jet that crashed in late December stopped recording in the final moments before impact. A joint team of Korean and US officials are trying to find out why the devices stopped working in the flight's final 4 minutes. The crash killed 179 people in South Korea's worst aviation disaster. Leaders of Indonesia and Japan have pledged to deepen bilateral cooperation on several fronts, including defence, energy and food security. Prime Minister Shigeru Ishiba met with President Prabowo Subianto on Saturday in West Java. Tokyo is attempting to boost its influence in Southeast Asia and counter China's growing presence in the region.
Dry, hot winds are expected to fan wildfires in Southern California in the coming days, promising little relief to thousands of exhausted firefighters. Bloomberg's Laura Curtis joins us now from Los Angeles. Laura, so what's the situation right now?
Well, it's a little bit better today than it was certainly in the middle of the week, but we are expecting another big weather event to start tonight, peak around Tuesday, and then go until Wednesday. So we're all sort of holding our breath and hoping for the best.
Laura, tell us about sort of the recovery efforts that will come after this, right? There's obviously already talk about rebuilding, but does there need to be sort of some difficult conversations about where and how these homes and businesses and structures are going to be rebuilt?
That's right. It's very early days for that. We have heard a lot of talk from officials like Governor Gavin Newsom and LA Mayor Karen Bass about how they are encouraging, even with permitting, to speed up, remove roadblocks to some of the rebuilding. They're sort of, talking about how we're going to build back stronger than before, but not really giving many details. These regions that are impacted are extremely vulnerable, and it's not really it's the geography that makes them so, and the change in climate. So it'll be interesting to see what kinds of, maybe it's new building materials or hopefully some shored up, firefighting capabilities, water infrastructure, that kind of thing. But yeah, those conversations are beginning to start, although it's hard to think about that when the place is still on fire.
Any idea at this point how badly insurance companies will get hit?
Oh, those estimates are very, very, very wide. I don't think we have a good idea yet. I mean, I've seen, estimates in $150 billion. It's the hardest part, I think, to see is that so many homeowners were underinsured or not insured at all because of California's insurance crisis. And so we're gonna see those storylines play out as well. What happens to people who lost everything and don't have an easy way to be made whole.
Laura Curtis, Bloomberg's US economy editor, with the latest on those LA fires. Well, coming up on the Asia Trade, our exclusive interview with the UBS APAC president, live from their Greater China conference. We'll also be speaking with the outgoing US ambassador to Japan, Rahm Emanuel, about regional relations under a Trump 2.0 presidency. And we also head to the Asian Financial Forum in Hong Kong today to talk with Pakistan's finance minister. Much more ahead, including those conversations on Bloomberg.
I think the Fed's in the refrigerator. They can't cut for, certainly March is off the table.
So this is kind of a Goldilocks type of report in a way. Of course, markets are trading it as a hawkish print. But the reality is that wages are growing at below 4%, even with job gains running this strong.
This is good for the economy. It confirms two things. One is the economy remains solid, and two is the U.S. continues to meaningfully outperform other advanced economies.
Financial conditions are really undermining the Fed's view that their policy is really that tight.
Everything at the moment is probably leaning to upside inflation risks, and it would put the Fed in a really, really tough spot.
Some of our guests reacting to that blowout December U.S. jobs report, which has already led to economists from Goldman Sachs, Bank of America, Citigroup to dial back expectations of rate cuts. And we have seen the market reaction already with the 10-year Treasury yield approaching 5%. What that means for the stock markets is a big question, right? I mean, we're talking about the cost of capital increasing for these companies, and the S&P 500 earnings yield now at 1 percentage point below what's offered by 10-year treasuries, making them more attractive. We've only seen this back in 2002. You can see the negative downside of S&P futures, NASDAQ 100 futures as well. Acting U.S. Labor Secretary Julie Su says the better-than-expected jobs numbers prove that the Biden administration is handing off a strong economy to President-elect Donald Trump. But she tells Bloomberg more needs to be done to ensure consistent jobs growth in areas such as manufacturing.
From the beginning, we said the unprecedented crises facing this country required an unprecedented solution, an unprecedented response, including by the federal government. And that's what we have done. And today's numbers, following on the heels of consistent, steady, stable growth, 16.7 million jobs since this president came into office. He is the only president that has had positive job growth every single month of his presidency. And that is what we hand off because we knew that that's what the American people deserved. And we knew that if we focused on what was good for workers first, that we could have a recovery like no other. And that's certainly what this month's numbers reflect.
Yeah, I believe we're looking at 48 months with consecutive payroll gains. And that, of course, is going in data going back to 1939. I do want to talk about the manufacturing sector, because if you're looking for some pain, you're going to find it there in the manufacturing sector, shedding jobs again in December. What do you think is going on specifically in that industry? Can we draw a line between those job losses to all of the different labor disputes that we've been seeing?
No, I would draw the line to really decades of economic policies, trade policies that have not favored workers and of commitment to jobs, which is also why President Biden came in and said, we're going to invest in manufacturing. As a result, the recovery that we've seen since 2021 is the only economic recovery in this century in which the manufacturing sector actually bounced back from a crisis like the one we inherited. And so there's more work to do. There's no question about it. And we know that workers in states where manufacturing has been the foundation need continued investments. And there's some uncertainty about that because the incoming administration has raised questions about whether those investments would continue. But what we've seen is that doing that, having the Inflation Reduction Act, right, having investments in bringing manufacturing back to the United States, into our heartland, is the right way to build the economy.
One more here on manufacturing here, because both American workers and investors alike are looking for any potential future pains that could come. How much do you see this as a harbinger for future cooling in the labor market, or do you think that this is just attributed to cyclical factors?
Well, I mean, at this point, any sort of change in direction in terms of investing in American manufacturing, right, investing in the companies who've committed to make things here and making sure those investments result in not just numbers of jobs, but good jobs, any reversal of that feels like it would be terribly irresponsible. And so, you know, we've certainly seen, again, the growth that we've seen steadily over this administration does not happen by accident. And the reversal of decades-long trends that have not been good for working people also cannot happen overnight. So my hope is that we are handing off the strongest economy in the world right now, and the work remains unfinished, and that commitment to workers, we hope, will continue too, so those manufacturing jobs can continue to come back. And we've seen 2 years of very strong growth in construction. That's non-residential construction. A lot of that is because of the president's infrastructure promises that we've been delivering on. And you got to build the factories before you can employ people in them.
That was the acting U.S. Labor Secretary Julie Su there. More ahead on the Asia trade. This is Bloomberg. Well, UK Chancellor Rachel Reeves sought to allay market concerns over the government's fiscal position during a trip to China, where she reached deals worth around $730 million to the British economy over the next 5 years. For more, let's bring in China correspondent Min Min Lo from Hong Kong. So what are some of the deliverables and outcomes from this trip?
Yeah, so this is a trip that was meant to revive high-level bilateral talks that has been put on hold pretty much since the pandemic. And Reeves was there along with the Bank of England governor, along with senior executives from the big banks like HSBC, Stanchart, and she met with Vice President Han Zheng and Vice Premier He Li-feng, who is the economic czar of China. And the two sides had signed a series of deals worth about £600 million to the UK over the next 5 years, and that includes plans to deepen financial services links between the two countries, for instance, enhancing the stock connect, and they're also looking at feasibility studies for a wealth connect as well as an ETF connect as well. And on top of that, the two sides also agreed to lift certain export bans, especially around the agri-food sectors, for example, that is supposed to help create more jobs for the UK, because this is a trip that is meant, at least as part of the UK government's efforts to try to bolster growth by attracting more foreign investment, as well as improving or bolstering trade with other countries. The two sides also look to liberalize sectors such as education and culture, where foreign investment are restricted. And of course, the UK delegation also raised certain issues of concern, including China's human rights records and its indirect support of Russia when it comes to the war in Ukraine.
And this meeting is so important, especially for Beijing, given its sluggish economy?
Yeah, there is that. And also ahead of Trump's inauguration, I guess you could see this as part of China's overtures to other countries, including the likes of Australia, Japan, India, and now the UK as well, to try to normalize or improve relations as part of its efforts to counter potential Trump tariffs, because that would likely require China to seek shelter in other markets outside of the US. But for the UK, it's a very different story, because Reeves is there. It's a very unpopular trip. She's seen as, in some ways, perhaps even kowtowing to China at a time when the UK market is facing a lot of turmoil. You're seeing sell-off in the pound, in government bonds as well. And she's under pressure to cut spending or raise taxes. And she has said and reiterated in her trip to China that her government is still committed to pursuing growth and that she will be looking or taking action to meet the self-imposed fiscal rules that she has set out in the budget.
Bloomberg's China correspondent Min Lo there with the latest. Take a look how we're trading in Australia just almost 30 minutes into the start of the staggered cash session. This is a picture when it comes to Aussie equities. We are seeing a little bit of downside there, over 1% in fact, trading on the ASX 200. We are sort of seeing that 10-year break even when it comes to the bonds market, the inflation rate rising to a 6-week high. Measures we're headed for the second daily rise that we've seen over the past couple of sessions, and we continue to see sort of expectations build for more of that cutting case for the RBA, given some of the data that's really missed expectations. The retail sales numbers coming in sluggish despite pre-Christmas and Black Friday discounts was just a recent, the sort of latest data point to potentially support that. The Aussie dollar at the moment looking pretty flat, but of course it is going to be that dollar strength story with the speculative positions at the highest since December 2015. Hedge funds dollar net longs now for 4 straight weeks. So we'll be watching to see the repercussions of that across Asia. We are watching Insignia as well, with the matching from Bain of that offer.
I think that it will have a negative effect on trade flows. And while I think that tax cuts will have a positive effect, if tariffs are raised, trade flows will slow down. And I think this is the biggest concern for companies, but I feel there's nothing I can do about it.
I don't think Mr. Trump will push more fossil fuel production as he has previously said. The US oil majors such as ExxonMobil are working on various activities toward green transformation. This is supported by the Inflation Reduction Act, so I don't think that Mr. Trump will scrap such a major trend.
Although there are various things being said about America First or tariffs, we still don't know what kind of changes will occur. I think it's better to be aware of the fact that change is coming rather than being pessimistic about it. I think that if change does occur, there will definitely be opportunities.
I think that the global peace is beneficial not only to the aircraft business, but to all industries. So I have high hopes for Mr. Trump as a world leader. We'll be paying close attention to the extent of the tariffs that are applied, as well as changes in the flow of people and goods. We would like to consider responses, such as reorganizing the network in response to demand, depending on the situation.
A host of Japanese CEOs are reflecting on the uncertainty surrounding policy changes after incoming President Trump takes office. And Shery, of course, we're really seeing positioning and preparation to the extent that, economies and governments around the world can prepare with what a Trump 2.0 administration might look like, particularly when it comes to these potential trade conflicts and tariff conflicts. And we've heard from Canada, we know that the sort of handling and rhetoric around how Canada would respond on tariffs was one of the reasons that we've seen the expected departure of Justin Trudeau, but we are also hearing from him the outgoing Canadian Prime Minister saying that Canada remains ready to respond with counter tariffs if the US imposes tariffs on Canadian products, and Canada of course buys more US-made goods than any other country. Trudeau is arguing that tariffs would actually be harmful to American citizens and jobs, and saying, look, they don't want obviously a trade war or a trade fight with the new administration, but as last time, they're ready to respond with tariffs as necessary, and also spoke a little bit about the efforts to strengthen border security and the broader importance of this relationship.
And yet we're now starting to hear from more business leaders, perhaps being a little bit softer on their assessment of what a Trump administration could mean, especially when it comes to those tariffs. JP Morgan's Jamie Dimon now saying that, yes, those could be actually effective tools to address unfair competition, and even going as far as saying that Trump is a skilled negotiator. Take a listen.
He's a negotiator. He lays out some very tough things, and sometimes it works. We have to worry more about national security, resiliency, diversified supply chains, and we didn't. And also we should have worried more about who it hurt.
Right. As we're ahead of the incoming Trump administration, we're also wrapping up the Biden administration. President Biden's ambassador to Japan, Rahm Emanuel, is about to wrap up almost 3 years in the role as the second Trump administration heads for the White House. Trump's threats of a trade war are looming large, as we've just discussed, along with potential shifts in security strategy around China and North Korea. And we're very pleased to have the ambassador join us here in the studio. Is on his final day in the office? Is this your final day in the office?
Final 24 hours.
Thank you so much for joining us. So how are you feeling?
A sense of accomplishment, also a sense of it's been 3 years almost to the day. We've got a tremendous amount of setting what I believe that the relationship has been reinvigorated, re-energized and reformed and better prepared for the future. And you hand your baton off. But at the same, as I jokingly say, while it's been 3 years, for the Japanese, it's felt like 30.
And you've actually said that. You said at the start of your tenure that the next 3 years would be very consequential for the next 30, right? How much has been achieved and how much more could have been achieved? Are there any areas that you would have liked to have done more?
Well, look, I mean, you hand off the baton. It's not like you run a race and you hit an equilibrium and there's a finish line. The question is, where was the relationship beforehand? Where is it when you walk off, exit the stage? And I think as a totality, whether you look at diplomatic front, the two trilaterals that we've created with Japan, the United States, Korea, Japan, United States, and the Philippines, you look at the security arrangement, the cooperation, the type of exercises we do, and integration of our forces, everything has been re-energized and reinvigorated and better prepared to reflect a credibility of deterrence to China and to North Korea. Take one example, last week when North Korea shot off another ICBM, both the Republic of Korea, the United States, and Japan were sharing intel in real time. Just one manifestation of a reflection of that didn't exist 3 years ago. In the same way that the President of the United States and the Philippine President and the Japanese Prime Minister had a conference call and discussing maritime issues in the South China Sea. That kind of coordination didn't exist. And one of the things I think also changed, in a subtle point, a lot of times when you think of deterrence, you think about battleships, missiles, planes. Having a trilateral with Korea, the United States, and Japan, or one with the Philippines, Japan, and the United States, that also is deterrence, because China's whole strategy is to isolate X country. Through our multilateral strategy and our lattice work, China's the isolated party in their own backyard.
We have seen the first administration of President Trump, though, how he engaged with these rogue nations, including North Korea's Kim Jong-un. Is that going to be a threat to everything that's been built so far?
Well, you know, I hate using sports metaphors, but let me try this. One is that the Indo-Pacific is a home game for China. It's an away game for the United States. You want to level the playing field and level the competition? You have allies. The one thing China doesn't have anywhere in the world, and specifically in their own backyard, Australia, Japan, Singapore, Korea, Philippines, India, they do not want to untether to China. They want the United States anchored here. That's a huge strategic advantage for the United States. We can project our deterrence, the credibility, so China doesn't try to do something either through economic coercion, political coercion, or military coercion.
Ambassador, you mentioned a number of countries that have vested interests in this, right? Do you think for countries like Australia and some of the other, I guess, middle nations around the region, is the alliance, a sort of counter-alliance, strong enough, or do you think there needs to be sort of more of an effort to work cohesively?
Well, let me say this, Heidi, on the question is, you don't hit an equilibrium and that's it. It's a work in progress. You're always improving. You're always strengthening. You have reciprocal agreements now between Japan and Australia that didn't exist before. You have 12 Coast Guard ships from Japan with the Philippines. Another 5, I think, or 6 are on delivery. You also have radar. You're constantly moving and improving your deterrence and the credibility behind your deterrence and the effectiveness on there. I do think when China began its wolf warrior strategy on the diplomatic front and its economic coercion on the economic framework, all the countries in the region realized and woke up to the fact that this was not a benign China. This was a China that was determined to crush their own sovereignty. That has helped, and the United States under President Biden has effectively used that threat to organize the region of like-minded countries that believe in the same set of principles to coordinate both their security front, economic front, and the diplomatic/political front. And that's been done in an enhanced level. And now, in China's own backyard, and they realize this, they are the isolated party because of the mistakes they have made and the policies they've adopted that have woken everybody up. This is not a China that talks about win-win. The only thing they know is they win, you lose.
The new Ishiba cabinet, we have a whole different political landscape here in Japan as well. They're going to be meeting with the new president, incoming President Trump. How do you expect that relationship to shape up? And
I'd be the last person to ask that question.
I mean, I'm really curious about what sort of chemistry we can expect. We saw the whole chemistry with former Prime Minister Abe and President Trump, and you have seen how governments here, officials, interact in Japan. Do you expect that? And I guess a follow-up to that is, would that have positive outcomes for the now delayed U.S. Steel, Nippon Steel business relationship?
Well, here's what I think is, it's not wrong to look at the two heads of state. As I saw firsthand, President Biden and Prime Minister Kishida have an incredibly warm relationship that helped push both leaders farther than their comfort zones. That said, one of the things that people lose sight of in the question, Japan has huge support on the Hill, Democrats and Republicans. And having been a congressman, having been a chief of staff, that has an impact on the construction of a national security vis-a-vis a country. Heads of state too, but do not lose sight. There's two countries that have huge bipartisan consensus. China on one side, Japan on the other. And that will have a big impact because by just one reference in our last 3 years, there have been 180 plus members of Congress. 2 speakers have come through Japan. And then second, you've had 30 governors. You've had an immense direct investment from Japan into the United States, as well as the United States in here. So you have 30 governors who have a vested economic interest in good relationship with Japan, and you have 180 members, both House and Senate, DNR, who also want to see our ally fully integrated into our strategic framework. Is that more
encouraging towards the Nippon Steel, U.S. Steel deal?
Well, look, here's one thing I would remark to everybody. And I think it's really, kind of important. One is the relationship is much deeper than a single business transaction. 5 years ago, Japan had the same words around Toshiba. Second, the United States, 4 months ago, awarded a Japanese company $20 billion contract to replace all the cranes at our ports and get the Chinese cranes out. Second, Japan is the only country that produces also co-production on the Patriot PAC-3. They've also a series of other weapon systems. Nothing speaks more to trusted ally than those examples. So is there a single economic transaction? Toshiba 5 years ago, relationship still strong. You look at the Nippon U.S. Steel today, the relationship is more complex and deeper in the roots and friendship than just a single economic transaction.
Ambassador, it was really great speaking to you.
Yeah,
and
thank you.
very much for always joining us and always being open to conversations with us. U.S. Ambassador to Japan, Rahm Emanuel, here in our Tokyo studio. And catch Japan Ahead every Monday at 8:40 a.m. if you're watching in Tokyo, and subscribers can see it live on the terminal using the TV Go function as well.
Coming up next, our exclusive interview with the UBS APAC president, live from their 25th Greater China Conference. This is Bloomberg. Let's get you to Shanghai now, where UBS's 25th Greater China Conference is underway, gathering more than 3,000 participants, including investors, policymakers, and top executives from listed Chinese firms. Key conversations will circle around investment opportunities, challenges across the region. Our Chief North Asia correspondent Stephen Engel is at the event for us and standing by with our next special guest, Steve.
Yeah, that's right. This is the 25th anniversary of this Greater China Conference by UBS here on the banks of the Huangpu River in the central business district of Lujiazui of Shanghai. We've been covering it in lockstep as well for about 2 decades. Bloomberg Television has, and we're very honored to have the Asia-Pacific head of UBS as well as the co-head of Global Wealth Management, Iqbal Khan. Thanks so much for joining us and having us here at the 25th anniversary. Congratulations to that. A very momentous event on the calendar here in China. Thank you, Steve. Tell me, I mean, you don't do a lot of interviews, so we're extremely gracious and grateful for having this opportunity. Tell me, what do you plan to tell the people who are gathering here, some 3,000 participants, and what are they asking you?
So firstly, it's great to be here in Shanghai. It is our 25th GCC, and we have record attendance, more than 3,000 people from all over the world. Which is really good, and you can hear the crowd already behind us. There's a little bit of a buzz and a lot of people here. Look, I think as we start out the year, everybody's focused on what do I need to know? What are the uncertainties out there? What are the opportunities? And how do I navigate these big topics? Geopolitics, macro, Asia, Europe, US, and different sectors, including AI.
Trump.
Well, I think generally geopolitics overall, the U.S., the upcoming inauguration, the U.S. administration, Europe, as well as Asia. People asking about the MPC in March and what will we expect from further stimulus and further macro actions based on what has been committed by China, which is a more proactive fiscal policy.
What's going to be your priority, or what has been your priority since you took over this role, this very high-profile role, the first time essentially a main division global head has been based out of Asia? You're based in Hong Kong, you're traveling all across the region. What is the priority over the last 4 months and then going forward for the next 12 to 24 months?
So look, firstly, it's a privilege to be out here in Asia and to be the first divisional president and co-president to be based out of Asia for UBS. We've been in Asia for a long time, more than 60 years. We were one of the first institutions out here in China to actually get the qualified foreign institutional investor status. QFI, absolutely. For us, Asia is very relevant. As you know, the two growth engines are the US and Asia. And from that perspective, for us, China, as much as Southeast Asia, Japan, and other markets are very relevant in terms of future growth. We're focused on growth in Asia. Now, will growth be linear? No. Are we going through a macro trough and there is geopolitical uncertainty? Absolutely. But there's a lot of opportunities. Wealth is growing in this region. If you think about wealth in China, adult wealth has grown 3x. This is the second largest capital markets in the world. And there's a lot going on in Asia and lots of opportunities. While we need to help our clients manage uncertainty and navigate through uncertainty, equally, one of the things that clients are telling us, specifically in Asia, is how can we help them diversify globally? And I think we as UBS clearly can differentiate ourselves vis-a-vis that, the competition.
And then how, in this time of turmoil in the Chinese economy, it's waiting for policy support, and the markets keep on getting disappointed. There was a big pop-up, obviously, in sentiment and also in the markets in September after the first round of stimulus, but we haven't gotten a lot yet. You alluded to March. March is going to be the National People's Congress. But the general consensus is among the high net worth individuals here in China is they're waiting, and they don't know necessarily where to entrust their money right now. I mean, the U.S. Treasury yields have been a great return on, essentially time deposits, better than returns out in this part of the world. So what kind of advice do you give these people that you're trying to attract more assets under management, obviously?
Diversification.
Pure and simple.
We are in the business of helping our clients build better investment portfolios. Diversification is key. In a world that is geopolitically more charged and maybe potentially less global, being diversified is important. If you had a regional bias or too significant of a regional bias last year, just as an example, and missed out some of the key markets like the US, you underperformed, your investment portfolio underperformed. So clearly diversification, global connectivity, bringing Asia to the world and the world to Asia, that is definitely a big differentiator we can bring to bear for our clients. And that is something we're very, very focused on.
U.S. obviously is not your remit, but again, what's happening in the U.S. impacts this part of the world. How do you see what's happening with the Fed possibly pausing? We had that very strong jobs report. Inflation is still very much sticky in the United States. You have bond yields. Everyone's watching that 10-year possibly crossing 5%. The 20 and 30, I believe, already have momentarily. What does that mean for Asia?
Well, generally, the entire rate curve and everything around rates policy, as well as inflation, has been a key topic and has now reignited again with what we're seeing in terms of the rate curve and what you just mentioned. There was a Bloomberg headline just this morning around scratching 5% in terms of 10-year yields. Having said that, we do still expect a gradual reduction in rates, but we will have to work through in scenarios. Why do I say that? We're waiting for an inauguration. We will see what the U.S. administration will be doing. There are scenarios out there. We need to work through those scenarios. We do believe that there will be continued rate cuts, maybe albeit a bit slower than anticipated, but this is something that we will have to work through.
You just said the Trump inauguration. He's threatened a lot of punitive issues, more protectionist American policy, including tariffs, as well as perhaps more debt issues. The deficit has been a problem in the United States. How do you see that impacting China in particular, which is trying to get some traction in its own economy?
Well, I think if you step back once again, and you look at some of the macro challenges in China, we're talking about the real estate sector, we're talking about local government debt, and we're talking about consumer demand. We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
You think that's what's going to happen in March? Because we've had some false starts, some false dawns, if you will, on the policy front. What would you like to see?
I think we would like to see continuous and sustainable steps towards addressing some of the more macro and fiscal challenges that China faces.
Will 2025 be tougher than 2024, though?
Look, every year, whenever we start a year, there's always this question, will one year be tougher than the other? One of the things that I've learned is don't always follow consensus. That was one of the things we learned when we went to Davos every year. Just think about scenarios, work through scenarios. You will always have additional information. One of the great things about GCC is figure out what is out there. What are the big knowns and what could be potentially the big unknowns, and how are you going to factor that in? Again, one of the key things that we are here to deliver is sustainable performance, sustainable impact for our clients. And we do that by making sure that their portfolios, their investment portfolios, are all-weather portfolios. And we work through this with our clients in making sure that they're diversified globally, as much as by sector and theme.
What does it mean for hiring? I know after the Credit Suisse integration, about 70 bankers were let go, but that's to be it is understandable as well. You have the largest team, I guess, of wealth managers, clients, or client managers at about 1,100. What kind of hiring to meet this potential demand and those uncertainties do you plan?
So you mentioned the Credit Suisse combination. Of course, this acquisition and subsequent combination is something that has been pretty good for UBS in the sense of the wealth management business. Looking at Asia specifically, this combination has been very complementary, both from a client segment perspective, but also from a market perspective. Think about our additions in Japan. Think about our additions in India, in Australia, but also gaining scale. We've gained 6, 7, 8 years of organic growth in terms of wealth management. So, of course, you could imagine in terms of headcount, we're going through the process of working through the combination and migration integration. We've been quite successful and ahead of time in terms of technical migration in Asia. 2025 will be the year for Asia where we're going to look at working through the combined organization, and we're focused on growth.
Give me an update on the China market, because you have about 67% ownership of the UBS securities, probably aiming for 100. Where are you on the timeline there? As well as I believe there's a securities from Credit Suisse, which potentially a part of that has to be sold. And also you have a joint venture, kind of a memorandum of understanding with the world's largest bank, ICBC. So it's a multi-part question. But first of all, talk about your process for licensing and gaining that 100% in securities, UBS, and then what do you plan to do with that ICBC JV?
So we're in the process of acquiring 100%, as you mentioned, and we're awaiting regulatory approval and working through that. So clearly, as you can see, we're committed to our securities business here in China, which has done very well over the last years and over the last 25 years while we've been doing the GCC. Equally, you mentioned ICBC. Yes, we're very happy with our joint venture partner, ICBC. This is something that we've done globally. We have partnerships in multiple countries, like in China, in Japan, in Brazil, and in other markets. This is something that has worked quite well for us to help us scale. At the end of the day, for UBS, the three key value drivers are financial and operational stability, right? It is driving value for our clients through advice, unbiased advice, as much as sustainable outcomes. Now, sustainable outcomes come with scale, and having scale is very relevant, and partnerships do help us gain scale.
Iqbal Khan, we could go on and on and on. I wish we could. Next time we're going to do a half hour, okay? We appreciate you having us here, giving us that exclusive interview. Best of luck in the GCC this year. All right, we're going to send it back to you. We have a full slate of interviews the rest of this morning here from Shanghai. Back to you.
Our Chief North Asia correspondent Stephen Engel there in Shanghai at the UBS Greater China Conference in its 25th year. We do have the market open in Seoul next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. We do have Japan away on holidays, but we are expecting other major market opens to see significant fallout from, of course, Haidi, the global bond rout that we continue to see with the 10-year Treasury yield approaching 5%. We have very strong labor numbers out of the U.S. on Friday. And will that threaten the stock market rally in the U.S.? We just saw the best 2 years since the dot-com bubble.
The reaction mechanism changing for investors has been really interesting, right? Because all of a sudden good news is bad news again, whereas we've sort of coasted along over the past couple of years, as you say, with pretty robust eco data, but still so much exuberance when it comes to US equities.
Yeah, and we are now getting eco data from South Korea as well. This market is going to come online very soon, and we're seeing the first 10 days of trade exports now rising 3.8%, while imports in the first 10 days of January rose 2.6% year on year. That left a trade deficit of $2.967 billion. Of course, we continue to watch these early indications of the trade dynamics across Asia. We had seen already South Korean trade for the month of December pick up a little bit from the previous month, especially with those chip shipments to China increasing. Japan away on holidays, but you can see right on that board that the yen is now weakening against the US dollar. Perhaps not surprising given, of course, rising treasury yields. Also that spike in the dollar gaining for a fourth consecutive session after the December jobs report. So the yen right now at very close to that 158 level. The Kospi and the Kosdaq under pressure. We had seen that pressure already across last week. With the Korean won, though, gaining a little bit of ground, it's going to be a big week for Korea, Haidi, as we have the Bank of Korea rate decision on Thursday as well.
Yeah, big week when it comes to some of these broader Asian assets, right, as we continue to kind of see the reaction, not to mention the strength in the US dollar positioning, how that's going to play out across emerging market and Asian FX. But take a look at the picture when it comes to just an hour into the start of trading this week for Australia. Quite a bit of downside there. Although we are off those session lows, I should point out, we are seeing some of those Australian stocks, so really being dragged lower by financials, some of the healthcare stocks as well. So really a broadly negative session. Also watching some of the miners, with Goldman Sachs highlighting the specific risks to the outlook for iron ore from a scenario of intensified Trump and US trade tariffs. So watching those stocks quite closely there as well. We do just have some data crossing the Bloomberg, the Melbourne Institute inflation month-on-month number for December coming through an acceleration of 0.6% year on year, seeing that 2.6%. So really coming down from a year-on-year number from the previous 2.9%, but a bit of an acceleration on a month-on-month. So it kind of continues to muddy the outlook when it comes to the RBA, but certainly broadly the data that we've had recently, including retail sales, pushing expectations for more easing and sooner from the RBA. Taking a look at US bonds as well as yields here in Australia and New Zealand as well. We're seeing government bonds here in Australia opening lower in the session, really tracking the moves in treasuries on Friday following what was really a blowout in non-farm payrolls numbers and that flattening quite sharply of the cash treasury yield there as well. So watching bond markets globally very, very closely. Let's bring in Chris Weston, Head of Research at Pepperstone Group, for his take. And Chris, you know, we've kind of been talking, I know you've been writing about the sort of reaction function across markets, right? What do you think has meaningfully changed? We were joking with Shery earlier about, you know, the data hasn't really changed since, say, before Christmas when we last spoke. But certainly the way that the market is choosing to invest has.
Yeah, well, I mean, obviously the situation now is we've got to a situation in real rates and the backup in longer-term nominal treasuries where things have started to concern traders a little bit more. And I think, you know, once we saw the JOLTS report coming out with the ISM services number earlier last week, you know, we did see treasuries spike up and equities roll over a bit. And obviously that same situation happened in payrolls where, we saw a strong number, of course, and yields rallied, yields rose and equities fell off. So, you know, I think markets had been in this situation where as long as it wasn't around the right tail risk, it was more about the growth dynamics. We could absorb better data and high yields because it was, obviously push back recession calls and continue to lift earnings. But now we're starting to see, with yields going higher, growth and labour market data has resulted in drawdown in the S&P and NASDAQ as well. And that is a new dynamic. So it seems that really all data last week, whether it's labour markets or growth data, is now seen as a negative as long as yields continue to push higher and real rates. And obviously the terminal pricing for where the Fed is continues to move up. We're at 413 at the moment on the terminal pricing. So I think that's the new reaction function we're in. And obviously that puts this week's US CPI number firmly in play there, because obviously that is the right tail risk that I think is more of a concern.
At this point, and you're right to point out, obviously, the biggest risk is that midweek CPI number. But at this point, what do you see as a potential risk to the US dollar? Because the positioning that we see, it seems very sort of one direction.
And rightly so. I mean, you look across G10 at the moment and there's really nowhere else you want to be. I mean, it gives you that relative growth. It gives you that protection or some sort of hedge against tariff risk. at least in the short term. You've got momentum and trend on your side, and you've got carry. So it's just this kind of magical beast at the moment, and positioning is justifiably long. Certainly in the real money community, you've obviously seen that length and leverage is a little bit less. But I think at the moment there isn't really that many other places in G10 you'd rather be. Japan's looking interesting. Obviously, last week we've seen talk of a lot of media speculation about a near-term rate hike. The market's certainly skewed to the idea that we are going to see a rate hike from the Bank of Japan later this month. And obviously the wage data recently has been better, but you'd be playing the yen against the cross rates. But so I think in the short term, really, the risk is that we do get a weaker than expected CPI number, core services and various factors go lower than expected, and that may be taking a little bit of the heat out of the Treasury move, and you see spreads come in a bit. Maybe the terminal rate comes back about 5 or 6 basis points. We'll have to see, but the longer term structural change in the US dollar, what will cause a significant reversal and a significant reduction in that positioning would have to come from better growth coming from other data points from other countries. It's not going to happen overnight. Maybe we get that after the German elections, see what their budget looks like. Maybe we're starting to see some signs that Chinese data is responding to the recent measures, and obviously we wait for the NPC meeting in March. But we really need to see the rest of the world pick up a little bit, or US data rolls over and starts to deteriorate, which at the moment is fighting a bit of a trend. So short term, it's about positioning. And some of CPI. Longer term, it has to be data in the US. Rate cuts get repriced, and the rest of the world picks up slack. Go on, sorry.
Even with that slight potential let-off that we could see on the dollar strength, would that make any meaningful difference for the British pound, for example? I mean, given that we have seen that market rout over there being compared to back in 2022 when we had these Truss's mini budget that, of course, just completely hit markets off guard.
Yeah, I think the UK is the exception to the rule at the moment. I mean, I think you're looking at investable places. I think the UK now in G10 is probably looking at the most dicey. They've got a really sort of very difficult backdrop to see in. I mean, obviously in the very, very short term, we've got a lot of short positioning in the pound, and if we were to see a lower CPI prints, then you could see gilt yields come under a bit of pressure and fall, and maybe that causes some relief in the pound. And also we've got a 10-year, a 4 billion 10-year auction coming through this week. And if we saw better demand coming through with yields where they are at the moment in gilts, then maybe that can cause some relief and shorts to cover in the short term. But I'd be selling into that. Obviously, everyone's focused on the backdrop. We've very little fiscal headroom that's coming in the UK. With growth across the PMIs in their GDP numbers, we get a midweek monthly GDP read. The growth is still very subdued, and it really does very much look like they're going to have to put taxes up at the next budget, which again just perpetuates the growth dynamic, which is slowing down. It's going to be a pretty onerous budget coming through, and obviously in that situation, people are looking at higher carry in the UK, which in traditional markets would be quite a good situation for the pound. It has been, over the last 6 to 12 months. But now that carry is such a poor quality because growth is deteriorating, it's working against the pound. So for me, everyone's looking to sell into any kind of relief rallies we get this week from a lower CPI print.
Is that sort of the feeling also with Chinese assets? I mean, we are going to get GDP numbers a little bit backward looking. We are going to get export numbers as well. But given that the PBOC has even suspended buying of government bonds, what can we make of the picture for Chinese assets in 2025?
Yeah, I mean, I think suspending a bond market is obviously a very radical step for any central banker to take. There is going to be a press release coming through this week, so we'll listen out for those signs. I mean, obviously, there's two ways to look at this. I mean, their inflation numbers are obviously pretty poor, and that's causing good buyers, had been good buyers coming through in the bond market, and the 10-year trading down to 160. But obviously, they're trying to reduce capital outflows coming through and reduce the one-way move that we've been seeing in the yuan ahead of these Trump trade negotiations. But in some capacities, you could argue that the lower bond yields we've been seeing could be a positive situation. Obviously, it reduces the cost of capital in China, and they're going to be issuing a ton of paper coming through to pay for some of these fiscal measures playing through. And of course, that's becoming cheaper for them to do so on the local government side. But I think really, you're looking at the data. We have started to see some green shoots emerging. Their PMI series is pushing higher. It is embryonic stuff, but if we were to see, as we go into the NPC meeting, the markets start to build a belief that perhaps for this time, I know we've been disappointed many, many times before, but perhaps they can bring out what needs to be done and actually please the market at a time when the US, perhaps equity markets are showing some fragility. Maybe that does offer some choice, but right now, when you close your government bond market, it really just disincentivizes international investors to want to be in China, and right now pretty much everyone's underweight. So I think as we go into March, there might be a strong tradable rally in Chinese equities, but for now the structural capital doesn't really want much to do with China.
Chris Weston, good to have you with us, head of research at Pepperstone Group, and we do have more ahead on the Asia trade. This is Bloomberg. UK Chancellor Rachel Reeves has sought to allay market concerns over her government's fiscal position during a trip to China, where she reached deals worth around $730 million over the next 5 years. Our China correspondent Mimi Lo joins us now from Hong Kong. So, Mimi, what were some of the tangible outcomes of this trip?
Yes, this is a very important trip, especially for the UK, because Rachel Reeves' government is under a lot of pressure to deliver economic growth to tackle the national debt issue and persistent inflation. She left for China in what is seen as quite an unpopular trip, just given the unfavorable perceptions around China. But she was there with the Bank of England governor, along with some senior executives of different banks, including HSBC, Standard Chartered. She met with Vice Premier He Li-feng as well as the Vice President Han Zheng, and the two sides agreed to this deal worth about £600 million over the next 5 years, including plans to deepen the financial services links between the two countries, such as enhancing the Stock Connect, and they're also looking at feasibility studies for an ETF Connect and a Wealth Connect as well. And on top of that, both sides agreed to lift export bans, especially around the agri-food business sectors that is supposed to help create some jobs for the UK, and both sides also agreeing to liberalize certain sectors like education and culture that had been restricted to foreign investment. But Reeves had taken to great pains to really highlight that she had also raised some of those issues of concern to the UK, including China's human rights record, especially here in Hong Kong, including the jailing of these pro-democracy activists, to appease some of the opposition to her trip to China.
In terms of the significance to Beijing?
Yeah, this is significant because China has, obviously, its economy has been faltering. It's been trying to boost trade with other countries. And this is coming just about a week before Trump's inauguration and the potential Trump tariffs that could be posing headwinds for Chinese exports. So China has been making overtures to other countries, including the likes of Japan, Australia, India, and now the UK. And at least from state media's coverage of this, the tone has been quite neutral, positive, I would say, painting the outcomes as being mutually beneficial for both sides. And so it looks like there is intention from China as well to try to stabilize and normalize relations here, just in case China will need to seek shelter from all these alternative markets outside of the US when those Trump tariffs kick in.
Bloomberg's China correspondent Min Lo there. Let's take a look at how futures in Europe are opening. And when it comes to the UK, stocks there have obviously had a pretty challenging start to the new year. That sort of honeymoon with the new UK government is seemingly over, with that sell-off in bonds, in particular the pound also taking some of those domestic-oriented companies' stocks down with it. And we've had that mid-cap benchmark FTSE 250 down by 2.9%. We're also taking a look at a potential further downside when it comes comes to European stocks in the medium term. We're seeing Euro stocks 50 futures up by about 0.2%. This coming back after a decline of almost 1%. That's stronger than expected non-farm payrolls number, really sparking broader concerns about what the Fed will do and how that's going to play out for some of these sort of ex-US markets as well there.
Yeah, perhaps one of those markets, China, of course, we have continued to see that market rout. Chinese developers starting 2025 also facing liquidation petitions, sliding share prices, not to mention mountains of debt. Despite government efforts to stabilize the property market, the crisis is now entering its fifth year with little sign of improvement. Bloomberg Intelligence senior APAC real estate analyst Patrick Wong joins us now for more on this. And Patrick, I mean, we have seen Beijing trying to implement those measures to ease policy, especially around the property sector. Are we expecting some of those measures to at least help some of those home sales by these major developers this year?
Yes, we recently see the challenge again, right? So the market, I think, in the last couple of months, potentially, hopefully we have the potential get the sales momentum better and better in major tier cities. But unfortunately, I think the challenge right now is that for some of the developers also not easy to get the sales momentum picking up. And those sales pick up, I think, is mainly on the state-owned developers. So like December, we see like China Overseas Land, the sales growth is very strong. But overall, I think for private developers, like recently we see like Country Gardens unit, I think the sales momentum is still quite weak. So the market, I think they still look for more easing measures to support the market. But it's not easy to see that because we have already rolled out lots of easing measures over the past couple of months. So that means for like maybe Shanghai, Beijing, some of those top tier cities may still have some room to have easing. But lots of other small tier cities, the sales momentum may still remain pretty weak going to this year.
Sunak says it can't rule out a second offshore debt restructuring. How could this play out, and what would be the sort of broader systemic impact if there is one?
Yes, I think the challenge right now is that for lots of default developers, they also suffer another chance of default. The momentum for the sales is quite weak so far. I think for lots of those developers, major buyers, they don't want to go for those developers already default, and also for those pre-sales will remain pretty weak for them. So usually buyers will prefer like stay-owned developers or going to the secondary market to buy homes rather than go to the primary market. So we see the down payment ratio already cut quite a bit, and also the mortgage rate also lowering. But the momentum still is focusing on some stay-owned developers, secondary market. So those default developers may still be having another challenge for suffer default again. So that is the major issues right now.
Bloomberg's APAC real estate senior analyst and head of Bloomberg Intelligence in Hong Kong, Patrick Wong, there with us. Take a look at what we're watching when it comes to oil prices at the moment. After being range-bound for so many months, we're really starting to see that breakout a bit more there. For oil is now hitting that 4-month high after what we've seen as sweeping US sanctions on Russia. US sanctions across the Russian energy industry could be seen to reduce global supplies, targeting oil exporters, insurance companies, as well as oil tankers. It could, in fact, force refiners in India and China to look to alternative suppliers. So this move that we're seeing could also, of course, have that longer play through when it comes to the feeding through to inflation, the complication of policy for central bankers and across the OPEC Plus alliance. But we have seen at the moment New York traded crude as well as benchmark Brent above that $81 a barrel there after jumping almost 4% in the previous session. We're seeing WTI at the moment trading just around that $78 mark there. These are the most aggressive and ambitious sanctions yet from the US on Russian oil that were announced on Friday, targeting 2 large exporters and a number of other players there as well, just less than 2 weeks before we see Donald Trump taking office. More ahead on the Asia trade. This is Bloomberg.
I think the Fed's in the refrigerator. They can't cut for, certainly March is off the table.
So this is kind of a Goldilocks type of report in a way. Of course, markets are trading it as a hawkish print. But the reality is that wages are growing at below 4%, even with job gains running this strong.
This is good for the economy. It confirms two things. One is the economy remains solid, and two is the U.S. continues to meaningfully outperform other advanced economies.
Financial conditions are really undermining the Fed's view that their policy is really that tight.
Everything at the moment is probably leaning to upside inflation risks, and it would put the Fed in a really, really tough spot.
Some of our guests reacting to that blowout December U.S. jobs report that also led to economists from Citi, Goldman Sachs, not to mention Wells Fargo as well, or Bank of America, excuse me, to have reduced their forecast for additional Fed rate cuts because of the employment numbers. And that really led to Treasury yield surging, the 10-year yield in the Treasury space now rapidly approaching 5%. And you can see Asia also following with that global bond tantrum that we're seeing. And it's interesting, will this continue is a key question, right? Especially with yields now spikes in the past having been pretty fleeting. We had the bond tantrums in 2013 and 2023 fading after a few weeks, Haidi.
Well, social media app Shery TikTok looks set to be banned in the US next week. That's after the Supreme Court signaled that it's likely to uphold a law that would force the shutdown unless it's been sold by its Chinese parent company, ByteDance. Let's bring out tech reporter Annabelle Jewellers for the details. So what did we hear from the hearing on Friday?
Well, this was really sort of summing up some of the arguments that we've heard so far. So just getting into a little bit more context on this. So the US Supreme Court, it was hearing arguments from both TikTok and also the Biden administration on Friday, relating back to this law that was passed by Congress last year, saying that unless ByteDance could find an owner for its app in the US, TikTok, it would need to sell that or divest it by January 19. So what the Supreme Court signaled is that it is likely to uphold that law. The arguments that we heard, as I said, they were sort of more of the same, but essentially the government's concerns, they really rely or relate back to national security. So there's concerns around data collection, espionage, propaganda. The concern here is that TikTok has a very skillful algorithm that's very good at selecting content, directing that to users. They're collecting a lot of information, and that they also, even though the US government didn't actually give any hard proof of this, but that TikTok could then also have sort of covert influence campaigns on its US users. TikTok, of course, relied back on its argument that any ban would be an infringement of free speech.
So what's next? And I guess also the question could be, could incoming President Trump perhaps save TikTok?
That's been really one of the key questions, and it's kind of unclear as to whether President Trump back in White House would have the ability to do that. It does seem what is next for now, at least, is that possibly by Jan 2021, the TikTok could sort of what's called dark, but essentially it would be taken off app stores in the US. Existing users as well, they'd no longer receive any updates. But it is a very complex issue because, as TikTok would say, divesting the app really brings its own challenges because TikTok has engineers in US, China, Europe. They're all working on the same source code. They're sharing that content. It's going to be a really big challenge, even if Trump, as we've seen, has really sort of flip-flopped on the social media app as well.
Annabelle Jewellers there with the latest. We'll have much more when it comes to the looming TikTok ban on the China show. We'll be speaking with Eurasia Group's Director of Geotechnology. More ahead, this is Bloomberg.
Take a look at how Asian markets are trading at the moment. We have Japan away on holidays, but the Kospi losing 0.4% right now, being led lower by information tech and consumer discretionary stocks. The ASX 200 is also down for a third consecutive session, perhaps not surprising given the global bond tantrum that we've seen, and also Wall Street finishing on Friday with the worst day since mid-December and actually turning negative for 2025. But Haidi, of course, is a busy week. We do have the start of earnings season in the U.S., not to mention data coming from China as well.
Yeah, and in terms of how that all plays out for Asian economies, will be top of mind for the Asian Financial Forum, Shery. That kicks off today in Hong Kong. More than 100 policymakers and business leaders gathering for conversations about the global economy. And our very own China show will be there live with anchors David Inglis and Rebecca Chong-Wilkins joining us now.
Yeah, good morning, Heidi, and thanks for having us. And thank you for the real estate on your show, of course. The China show starts in a couple of minutes from now. And, you know, lots of good conversations coming up here. We are expecting a lot of VIPs. In fact, some of them are already starting to walk in behind us. The main stage is to our left. So do expect, and don't be surprised if you see some of them walk right behind us. As you can see, Rebecca's here, also joining us here on set.
The first sort of big, real international financial event of the year for Hong Kong.
Yeah.
Major. We're expecting potentially John Lee to be joining us later today, give us that inaugural speech. But yeah, I mean, it's sort of, these things are always sort of a bit like nerd prom, right? I mean, you can finally have all these conversations and questions that you've been wanting to ask.
I've had an extra coffee already. I'm looking at the agenda. Can't wait to get started. Why don't we kick things off in our conversations here on location today? Joining us here on set is Pakistan's Minister of Finance and Revenue, Mohammed Aurangzeb. It's very nice to see you, and good morning. Thank you for the time.
Good morning. It's a pleasure to be here.
How was your trip in?
Fantastic. It's almost after 7 years that I'm back in Hong Kong. As a private sector professional, I used to be here almost every single month.
Right.
So as I said, it's absolutely great to see hustling and bustling Hong Kong here. So great to be back.
Understood. And yeah, you know, we were talking on the break, and just for our viewers here, we'll pass your regards along to our other colleague who you know very, very well. Let me ask you now, let's get started. The conversations between Pakistan and the IMF, do we know when the next mission is going to be, when the next group from the IMF will be arriving in Pakistan, and when those talks will begin?
Yeah, and as you know, on the back of a successful 9-month standby arrangement, we went into a larger and longer program with the fund. It's a $7 billion program over a 37-month period. So that was approved by the executive board in September. So we are well into that program, and the first official review mission will arrive mid to end February, because we are now on a 6-monthly review.
Right. Economists have expressed some concern about the ability to reach the tax targets. Are you on track? What are you aiming to reach?
Yeah. So the reason we went into the EFF and IMF was very much around two aspects, or two goals. One was to bring more permanence in the macroeconomic stability that we have achieved as a country in terms of stable currency, FX reserves, which are now more than 2 months of import cover, and inflation coming down, policy rate coming down, interest rates coming down. And the second one is back to your point, which was around structural reforms. To get to tax to GDP ratio of about 13.5% during this time period. And I can tell you in December we got to a number of 10.8%. So what I would say, we are well on our way to achieve that target. Not only because IMF is saying that, it's from my perspective, the country needs to get into that benchmark to make our fiscal situation sustainable.
And some of our viewers might have, just to address the elephant in the room there, our lights went off a little bit right now, so they're back on. The conversations around, and the lots of moving parts to your point, and hopefully, of course, things do go according to plan. Are new taxes or tax rates on the table if you do need to revisit those options?
Well, from our perspective, we are very clear that we are focusing on two things. One is to widen and deepen the tax base, so the sectors which were outside the net, like agriculture, like real estate, like wholesale retailers, bringing them into the net. And secondly, increasing compliance. Compliance means all the leakage in the system has to go away. Very much focused on these two aspects, and therefore remain quite determined to get to that tax revenue number by doing both of these.
Your growth target for next year, 3.6. Can you reach the 3.6? Of course, the World Bank has expressed some concern, saying under 3%. What are you targeting next year? What are you on track for?
Well, I think now that we are into that phase of stabilization, now where do we go from here? We have to very much focus on sustainable growth. because what has happened in the past, and that's why the country has gone through boom and bust cycles, is that the moment we touch 4%, because it's an import or has been an import-driven economy, we get into a foreign exchange issue, balance of payment problem, and we go running back into the fund. So what we are now very focused is to fundamentally change the DNA of the economy to make it export-led. So 3.5% for this fiscal year, and then over the next 2 to 3 years, moving towards a 6% target.
Do you expect to then, I think as a next step maybe, do you expect to then be able to tap again the global bond markets, for example? And do you expect also some credit ratings upgrades if that is, of course, on deck?
Yeah. So we have had credit rating upgrades, sovereign upgrades from all three rating agencies over the last sort of 8 to 10 months. But the reality is, before we go back into euro or Reg S 144A, we need to get back into a single B category. I'm quite optimistic that during this fiscal year we will see that upgrading, and once is there, we will go for go back into the national capital markets. Having said that, I'm very keen, and the country is very keen to tap the Panda bond. And the Chinese capital markets. It's the second largest, second deepest capital market in the world. We have been remiss as a country not to tap it previously. So we are working very closely. CICC has been appointed as our advisor on this. And what we are trying to do is to follow the Egyptian model, to get some level of credit enhancement. As you know, in Egypt's case, it was AIB and African Development Bank which provided the credit enhancement, and therefore they were able to launch. And we are trying to follow a similar track following Egypt's footsteps.
This quarter for the Panda bonds?
Sorry?
Could it be this quarter for your Panda bonds?
This quarter might be ambitious, but certainly during the next sort of 6 to 9 months, we hope to print an inaugural bond.
And as a final question, do you have an amount in mind with CICC? Have you discussed that?
For us, quite frankly, the amount does not matter that much, because our external situation is quite comfortable. But from my perspective, anything in the $200 to $250 million equivalent RMB range would be a good place to go for the inaugural issue. And then, of course, we can keep it on tap.
Minister, have a good rest of the year ahead. Thank you so much for the time and joining us right now. Your team is already signaling that I think you're ready for the next engagement there. That was Pakistan Minister of Finance and Revenue Mohammed Aurangzeb here, of course, here on Set With Us at the Asian Financial Forum. Back to you guys in your studios.
David Inglis and Rebecca John Wilkins there on the ground for us. Some of the other stories that we're following from around the world. Prime Minister Justin Trudeau says Canada will be ready with counter tariffs if Donald Trump carries out his threats of a trade war in North America. Trudeau told MSNBC that Canada isn't looking for a trade fight, but will respond if needed. Bloomberg sources say one draft retaliation plan circling in the Canadian government would affect almost every product category imported from the US. And the former Bank of Canada Governor Mark Carney is expected to join the race to succeed Trudeau as the next Prime Minister. The CBC reports that Carney will announce his bid later this week with the support of more than 30 MPs. Carney holds a series of business and philanthropic positions, including chair of Bloomberg Inc. Leaders of Indonesia and Japan have pledged to deepen bilateral cooperation on several fronts, including defence, energy and food security. Prime Minister Shigeru Ishiba met with President Prabowo Subianto on Saturday in West Java. Tokyo is attempting to boost its influence in Southeast Asia and counter China's growing presence in the region. Incoming US Vice President J.D. Vance says a deal to release hostages held by Hamas could still be struck before Donald Trump returns to the White House. Vance told Fox News it could happen in the last day or two of the Biden administration. White House Security Advisor Jake Sullivan also told CNN that a deal is close, but warned that it could still fail. Israel said on the weekend that it was sending negotiators to Qatar for fresh talks. More ahead on the Asia trade, this is Bloomberg.
Bloomberg Intelligence says the market for high bandwidth memory is set to soar from $4 billion of sales in 2023 to $130 billion within a decade. HBM chips are critical to the development of AI, and our analysts expect just 3 companies will control the market: SK Hynix, Samsung Electronics, and Micron Technology. Let's get more on the opportunities and risks in AI from the UBS Greater China Conference in Shanghai. Stephen Engel is there with our next guest. Steve.
Yeah, that's right. HBM chips, high bandwidth memory, obviously key to the acceleration and processing power into AI of NVIDIA and the likes. But we want to talk further about artificial intelligence, AI, with our next guest, Zack. Kass. He is an AI strategist and a futurist. Thanks so much. He's also the former OpenAI head of go-to-market. So you're here at the UBS Greater China Conference. You'll be giving a speech, or a keynote here. What's your AI message to a room of 3,000 bankers?
Well, yeah, I mean, broadly the message is this is exciting, which they already know, but I think there are a couple ways to take it. The first is that financial services is going to change a lot.
How so?
Well, I mean, I think we have to assume that at a retail side, the expectations that consumers have for how they will bank is going to change as the consumer experience across their mobile device changes, and especially with the generative AI. If banks don't update to a new retail world, I think they will have a threat like the neobank presented, except much greater.
Yeah.
And I think we should just expect that.
I saw one of your keynotes on YouTube essentially talking about the democratization of compute and the abilities and the costs coming down, and that it's going to be great for all society. And it's, the cost is coming down much faster than Moore's law processing speed in the chip industry. So we could see a democratization. But is that necessarily what will take, for example, the banking world? They want a competitive advantage, do they not, from AI and the applications?
I'm sure they would love if they had, they were the only ones who had access to this technology to a certain extent. Markets want competitive advantage. But I think as far as you and I are concerned, or frankly most of the world, anytime a critical resource declines in cost this much or this quickly, there is a Cambrian economic explosion, and it is very good. We want, as people in this world, for important things to be inexpensive. That is good for society. This happened with water and foodstuffs, electricity, the internet. Happening with AI this much, this fast is really exceptionally good, because it basically means that we won't be controlled by either a single company or a single provider.
Yeah.
And we want that.
You likened it in one of your speeches to the Wright brothers to landing on the moon, just about 60 years.
Yeah.
That industrial revolution that we saw in aviation travel. How so is this going to change the way we operate in the world with AI?
Well, the Wright brother moment that we talk about, I talk about 2 Wright brother moments all the time with friends. The one is Roger Bannister, right? Before Roger Bannister, no human thought that a 4-minute mile was possible, or we weren't sure. Roger Bannister runs a 4-minute mile. Within a year, 10 other men have done it. Wright brothers fly a plane. Within 60 years, you have a man on the moon, the Apollo project. Humans are inspired not just by technological advances, but by seeing other humans do things. And so what we're seeing in China in particular is the inspiration drawn from the necessity of compute shortage to massively improve the cost efficiency of these models is one of these incredible breakthroughs that actually comes because of scarcity. And we are now in this new normal where things are going to happen so much faster than we could possibly appreciate.
Then how do you see it, since it's a bifurcated geopolitical world between China and the United States, and the development of AI is working in silos?
Well, so to be clear, I actually don't know that it's perfectly working in silos. We should all appreciate that, first of all, because of programs like Meta's open source project, Llama 3.1 is publicly available, and obviously China is going to work on that model to improve it. Moreover, a lot of science is still published. And so we should appreciate that the world is actually still sharing a lot of information. Just because China's internet is pretty insular and some of China's models are insular doesn't actually mean that the West and the East are not actually sharing best practices. And that's a good thing, because parity is not bad. We should remember that parity is actually a good thing. It keeps the world in a fairly stable position. And what we're seeing out of China is that they are producing exceptional models that actually require less compute, because, of course, they have less compute.
Yeah, that's right. But let's talk about this industry in particular. Bloomberg Intelligence did a survey of global banks and talking about headcounts are going to be reduced quite considerably. It's something our clients read on the Bloomberg terminal consistently. Job opportunities and job cuts. I'll just summarize. They predict global banks will cut as many as 200,000 jobs over the next 3 to 5 years as AI encroaches on tasks that are carried out by us mere mortals. Would you agree? Is that a normal projection that some 200,000 jobs could be lost in the financial sector?
Well, first of all, I'll say it would not surprise me to hear that millions of jobs were changed over the next 3 to 5 years. So I'll just start by saying that. Whether or not 200,000 jobs are lost net, it could break either way. But I think what's important to remember is two things. One, job loss comes with it two interesting things. One, a new sort of marketplace dynamic, wherein we now have a new supply of labor, and that supply of labor can go do other interesting things. The other thing that happens when banks actually start to pare down their costs is they can start to deliver more efficient products. And one of the things that we constantly talk about is the idea that banks need to deliver better products more efficiently, more fairly. One of the things that makes banks unfair, as the average person is concerned, is the fact that they are run by people. They're not corrupt institutions. They're institutions where people make mistakes. The fewer people in a lot of these core processes, the better that banking systems probably get. The other thing I would say, Stephen, is, and this is, for a longer conversation, the thing that people are not paying attention to is not the economic consequences of job loss. Everyone is fixated on this idea of if we lose our jobs, then we won't be able to work and we won't be able to make money.
What do we do next?
But that's not actually what's happening. What's happening is that as we start to automate work, the cost of goods and services will massively come down. Right? We will have a deflationary event. The real question is, what will we do with ourselves? What is our identity then? In a world where we attach so much of our identity to our work, the risk, I think, in all this is an identity displacement crisis. And I talked about this to anyone who will listen. Yeah. Focusing on the idea that you will lose your job and therefore you won't have money is misguided. Focusing on the idea that your job may change and therefore you won't feel like you're whole, that's a whole other issue.
We have to figure out how to use the excess time that we're going to get because of AI, right? And not just into retirement. We're talking
well beyond.
Well beyond.
Yeah.
And you were talking about a 3-day work week is probably warranted.
I mean, 3-day work, I put these out there because these are sort of markers in the sand, but yeah.
I'm all on board.
So am I, for what it's worth. I mean, people are always like, well, what will you do when AGI shows up? It's like a gotcha. And I'm like, listen, I'll play volleyball in Santa Barbara. This is not that hard for me.
That's right. That sounds good. Not right now.
Not yet.
Because there are fires right now. Yeah. Zack, Kass, thanks so much for your time. Next time, let's talk for a full hour or so.
Sounds great.
All right.
Thanks for having me.
I'm going to send it back to you. Much more coming from the banks of the Huangpu River here in Lujiazui, Shanghai. Back to you.
Our Chief North Asia correspondent Stephen Angle there in Shanghai. That's at the UBS Greater China Conference, of course. More ahead also on the Asia trade. This is Bloomberg. All right, this is a picture across markets as, of course, we see that continued repricing and really risk assets under pressure after what was unexpected or perhaps just a level of strength in those US jobs numbers. The markets were not quite willing to contend with. We're seeing that slippage here when it comes to S&P futures continuing to see losses about 0.1%. We're also seeing going into the start of trading in Greater China, Taiwan futures down by about 0.6%. And, of course, a lot of downward pressure when it comes to the start of trading this year for Chinese stocks. And it has been a pretty miserable start there with the worst beginning to a year since 2016. But still, we are getting some potential implications when it comes to Goldman's. They see a 20% rise in China stocks in 2025. So potentially, if you've got the risk appetite, this might be a good chance to buy on that dip. Well, earlier we spoke with UBS's APAC president, Iqbal Khan, for an exclusive interview at their Greater China Conference. To Stephen Angle, Khan said earlier that he sees the US and Asia as growth engines and also why he expects US rate cuts to continue.
Well, generally, the entire rate curve and everything around rates policy, as well as inflation, has been a key topic and has now reignited again with what we're seeing in terms of the rate curve and what you just mentioned. There was a Bloomberg headline just this morning around scratching 5% in terms of 10-year yields. Having said that, we do still expect a gradual reduction in rates. But we will have to work through in scenarios. Why do I say that? We're waiting for an inauguration. We will see what the U.S. administration will be doing. There are scenarios out there. We need to work through those scenarios. We do believe that there will be continued rate cuts, maybe albeit a bit slower than anticipated, but this is something that we will have to work through.
You just said the Trump inauguration. He's threatened a lot of punitive issues, more protectionist American policy, including tariffs, as well as perhaps more debt issues. The deficit has been a problem in the United States. How do you see that impacting China in particular, which is trying to get some traction in its own economy?
Well, I think if you step back once again and you look at some of the macro challenges in China, we're talking about the real estate sector, we're talking about local government debt, and we're talking about consumer demand. We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
You think that's what's going to happen in March? Because we've had some false starts, some false dawns, if you will, on the policy front. What would you like to see?
I think we would like to see continuous and sustainable steps towards addressing some of the more macro and fiscal challenges that China faces.
Will 2025 be tougher than 2024, though?
Look, every year, whenever we start a year, there's always this question, will one year be tougher than the other? One of the things that I've learned is don't always follow consensus. That was one of the things we learned when we went to Davos every year. Just think about scenarios, work through scenarios. You will always have additional information. One of the great things about GCC is figure out what is out there. What are the big knowns and what could be potentially the big unknowns, and how are you going to factor that in? Again, one of the key things that we are here to deliver is sustainable performance, sustainable impact for our clients. And we do that by making sure that their portfolios, their investment portfolios, are all-weather portfolios. And we work through this with our clients in making sure that they're diversified globally as much as by sector and theme.
UBS APAC President Iqbal Khan speaking to our Chief North Asia correspondent Stephen Engel at the UBS Greater China Conference earlier today. That's it from the Asia Trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. The China Show is next. This is Bloomberg.